In 2018, Amazon, the most valuable company on Earth, reported $11.2 billion in United States pre-tax income. Its federal income tax bill? Negative $129 million. That's right, Amazon didn't just pay zero. The IRS paid Amazon, a company that earned more in a single year than the entire GDP of 90 countries on Earth, received a check from the American taxpayer. This wasn't fraud. It wasn't a glitch. It was the tax code working exactly as written, a masterclass in turning profit into nothing. This is how Amazon legally erased $35 billion in taxable income and made the IRS pay for the privilege. To understand how Amazon paid zero, you first need to understand the scale. From 2017 to 2021, Amazon reported more than $35 billion in United States pre-tax profit. In a normal world, at the 21% corporate tax rate, that would mean a federal tax bill of roughly $7.4 billion. Instead, Amazon's effective federal tax rate over those 5 years averaged just 5.1%, barely a quarter of what the law intended. And in 2 of those years, 2017 and 2018, the rate was literally zero or negative. Amazon wasn't cheating. Every strategy it used was written into the tax code by Congress. It combined 5 perfectly legal tools, each one available to any corporation, and stacked them on top of each other until the bill disappeared entirely. Let's break down each one. The first and largest tool in Amazon's kit was stock-based compensation. When Amazon gives employees stock options, the company gets to deduct the value of that stock when employees exercise it. Not what the company paid for the options, but what the stock is worth on the open market at the time of exercise. In 2020 alone, Amazon's stock compensation deduction reduced its taxable income by more than $5 billion. Think about that. Amazon paid employees partly in stock, the stock price climbed, and the higher it went, the bigger the tax deduction became. It's a system where success is literally subsidized. The more valuable the company grows, the less tax it pays. And since Amazon's stock price increased by over 1,200% between 2010 and 2020, this deduction grew into a tax-erasing machine that saved the company billions every single year. The second strategy was accelerated depreciation. Amazon invested $61 billion in capital expenditures between 2016 and 2020, building fulfillment centers, data centers, delivery infrastructure, and robotics facilities across the country. Under normal accounting, those investments would be deducted slowly over their useful life, 10, 15, 20 years. But under accelerated depreciation rules, turbocharged by the 2017 Tax Cuts and Jobs Act, which allowed 100% bonus depreciation, Amazon could write off the full cost of many assets in the very first year. In some years, Amazon claimed over $10 billion in depreciation deductions. That's not a loophole. It's a deliberate incentive written into the code to encourage corporate investment. But when one company invests at Amazon's scale, the deduction swallows the entire tax bill whole. Strategy number 3, research and development tax credits. Amazon spent over $73 billion on research and development between 2016 and 2022. That's staggering research investment, spanning everything from Alexa to Amazon Web Services to warehouse robotics to autonomous delivery drones, generated substantial tax credits. Now, tax credits are even more powerful than deductions. A deduction reduces taxable income. A credit reduces the actual tax bill, dollar for dollar. For every $1 million Amazon spent on qualifying research, it received a direct reduction to its federal tax liability. The R&D tax credit was originally designed to keep American innovation competitive on the global stage. And Amazon, with its relentless, almost obsessive investment in technology, became one of the single largest beneficiaries of the program in American corporate history. Strategy 4. Net operating loss carryforwards. Amazon was famously unprofitable for years. The company didn't turn a consistent annual profit until 2015, more than 20 years after Jeff Bezos founded it in his garage. During those lean years, Amazon accumulated billions in tax losses. Under United States tax law, those losses don't expire. They carry forward indefinitely, waiting to offset future profits. When Amazon finally became massively profitable, it still had a stockpile of historical losses sitting on its books, reducing its current tax bill year after year. It's like a coupon book that never expires. Every dollar Amazon lost in its early years became a dollar it didn't have to pay tax on later. The tax code effectively rewarded Amazon for 2 decades of red ink. Now stack all 5 strategies together and watch the bill vanish. Stock-based compensation, billions in deductions. Accelerated depreciation, billions more. R&D tax credits, billions in dollar-for-dollar reductions. Loss carryforwards, billions in historical offsets. And the 2017 Tax Cuts and Jobs Act, which slashed the corporate rate from 35% to 21% overnight. Each strategy alone would be significant. Combined, they created something extraordinary. A company reporting $11.2 billion in profit that owed the federal government less than nothing. Amazon's effective federal tax rate in 2018 was negative 1.2%. The IRS didn't just let Amazon keep its money. It sent Amazon a check. But Amazon's tax advantage didn't stop at the federal level. In September 2017, Amazon announced a search for a second headquarters, HQ2. 238 cities across North America submitted bids, each one trying to outdo the others with tax breaks, subsidies, and incentives. New York City offered $3 billion in tax breaks. Newark offered $7 billion. Chicago for $0.5 billion. It was the largest corporate bidding war in American history, cities competing to give public money to the most valuable company on earth. Amazon ultimately chose Arlington, Virginia, where it received $573 million in state incentives, and New York, though the New York deal collapsed after fierce public backlash over the $3 billion subsidy package. The HQ2 saga revealed an uncomfortable truth. Amazon wasn't just avoiding taxes through the federal code. It was actively extracting them from cities desperate for its jobs. Amazon's tax engineering extended well beyond American borders. In Europe, Amazon routed billions in profits through a subsidiary in Luxembourg, one of the smallest countries in the European Union. Under a private tax ruling granted by Luxembourg in 2003, Amazon was allowed to shift the vast majority of its European profits to a Luxembourg holding company that paid almost no tax. The European Commission investigated and in October 2017 ordered Luxembourg to recover approximately €250 million in unpaid taxes from Amazon. But in May 2023, the EU General Court overturned the ruling, concluding that the Commission had not proven the tax arrangement gave Amazon an unfair competitive advantage. Luxembourg kept its golden goose. Amazon kept its arrangement. And European taxpayers, the ones who bought the products, used the services, and drove the revenue, received nothing. Here's what makes this personal. While Amazon paid an effective federal tax rate of 0% in 2018, the average small business in America paid between 19 and 25%. A restaurant owner earning $200,000 in profit paid more in federal income tax than a company that earned $11.2 billion. The tax code is supposed to be progressive. Those who earn more should pay more. But in practice, the tools that erase corporate tax bills, stock compensation deductions, accelerated depreciation, R&D credits, loss carryforwards, are only available at massive scale. A local bookstore can't claim $5 billion in stock compensation deductions. A neighborhood bakery can't build data centers across 3 continents. The system doesn't tax income equally. It taxes the inability to play the game. The backlash eventually arrived. In August 2022, President Biden signed the Inflation Reduction Act, which included the Corporate Alternative Minimum Tax, a 15% minimum tax on companies with adjusted book income exceeding $1 billion. For the first time, companies like Amazon would have to pay at least something, regardless of how many deductions and credits they stacked. And on the global stage, 136 countries agreed to the OECD Pillar 2 framework, a 15% global minimum corporate tax. Amazon's effective federal tax rate climbed to around 11% in 2023. Still below the statutory 21%, but a far cry from the 0% days of 2018. The era of the vanishing tax bill may be ending. But the question remains, is 15% on tens of billions in profit really enough? Or is it just a new floor in a building designed for those who know how to use the elevator? When a company earns $11.2 billion and pays less than your monthly phone bill and taxes, the system isn't broken. It was built this way. This is TaxMap, and we trace the routes they don't teach in school. If this story made your jaw drop, subscribe and hit the bell, because our next video reveals Dubai's zero tax trap, the hidden costs no one warns you about before you move. Drop a comment. What shocked you more? Amazon's negative tax rate, or the 238 cities fighting to hand it even more money?